When it comes to maintaining a successful portfolio, it comes down to having a solid foundation and a diversified portfolio. The easiest way to diversify your portfolio is through ETFs and index funds. This doesn't mean we need an equal weight across every different sector by any means. And in today's video, we're going to talk about 2 ETFs that can pack a powerful punch in terms of growth moving forward. But before we dive into those, do me a huge favor. Click that like button down below, subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, you can check out their top 10 stocks to buy right now by going to fool.com/Mark. Check out the link down in the description below. All right, let's jump back into our video, taking a look at 2 ETFs to think about doubling up on. And both of these ETFs are not well known, so it may be a first time buy for you. Beginning with ETF number 1, which is going to be the iShares Core S&P Small Cap ETF, stock ticker IJR. And when we talk about small caps, the most popular ETF that's out there is going to be the Russell 2000 ETF, stock ticker IWM, and rightfully so. It gets a lot of attention. It invests in a lot of small cap stocks. But I'm going to tell you about a better small cap focused ETF, which is going to be IJR. Like the Russell 2000 IWM ETF, IJR also focuses primarily on small cap stocks. It is tax efficient. And in terms of performance from the small cap sector as a whole, they have greatly underperformed the greater S&P 500. With SPY gaining over 180% and IWM gaining less than 90% over a 10-year period. However, there was a lot that has gone in and been thrown at the economy and the stock market over the past 10 years. We had a global pandemic, we had sky-high inflation, which led to extremely high interest rates, a fast-moving hiking cycle, which all do not bode well for small-cap stocks. So when we look at the decade prior to this, we can see a completely different story. In fact, it is small caps that led the way, bringing in over 100% return compared to the S&P 500 gaining roughly 75%. So are we entering into a 10-year period like we just saw, or a 10-year period that we saw prior to that? For all of our sakes, let's hope it's the 10-year prior to that. And there's plenty of reasons to be excited about small cap growth moving forward. If the economy can return to strong amounts of growth, which 15% earnings are expected in 2025, that's pretty solid. Interest rates are expected to come down starting this very month. All of those things bode extremely well for small cap stocks. So now let's take a look at IJR and how it has performed as compared to the popular IWM small cap ETF. Let's begin with the decade from 2004 to 2014, where you can see IJR outperforming IWM by nearly 30%, totaling 130% return during that period. Now, when we look at the last 10 years, so the most recent decade, what do you see? Yet again, IJR outperforming the more popular IWM with 110% return. So from a performance perspective, IJR is the clear winner, not just in the past decade, but even the decade prior to that. Now let's take a closer look at the expense ratio. When it comes to investing in ETFs, it is so important to focus on expense ratio and not overlook it. IWM, which is more popular with option traders, charges a 0.19% expense fee, which is relatively okay, but not as low as the 0.06% that IJR charges. So from a performance perspective, IJR outperforms. From an expense ratio perspective, IJR looks better. Now let's take a closer look at the portfolio. And when it comes to these companies, again, all of them are going to be small cap. There can be a whole different multitude of different types of companies. Small cap companies that are profitable, small cap companies that are break even, and small cap companies that are just losing money. It is a wide range and hundreds of thousands of different companies. When you invest in something like IWM, you are really catching all of those. Over 2,000 different companies are within that ETF. But when we focus on IJR, we are focusing more on higher quality, larger small cap companies, because the focus here is only on the top 600 small cap companies. Looking here, you can see the fund is extremely well diversified with financials, industrials, consumer discretionary, technology, and healthcare making up the top 5 sectors, each with a weighting of 10% or more. Looking here, you can see the top 10 positions in the fund. Leading is the BlackRock Cash Fund, followed by Ensign Group, Fabrinet, ATI, Mueller Industries, Comerica, Meritage Homes, SPS Commerce, Carpenter Technology, and SPX Technology. In total, there are 611 positions. So if you're in the market looking to get ahead of the rate cuts and looking for small cap exposure that performs well, look no further than IJR. And that leads us to ETF number 2, which is going to be the Franklin FTSE India ETF, stock ticker FLIN, or as I like to say, Flynn. And if you haven't been paying attention to the growth, the consistent growth that's been taking place over in India, as an investor, it's time to take notice. One of the students that I meet with regularly in my 6-week Investing Accelerator course, we looked at this ETF a few weeks back and we both loved what we saw. I'm now sharing that with you. India as a country recently ended their most recent fiscal year. That saw GDP growth of 8.15%. And the country as a whole has exceeded expectations, growing more than 8% for 3 consecutive years and counting. And that growth is not expected to slow either, as economists are looking for much of the same for the next few years, maybe down slightly at around 7.5% growth moving forward. For a few years now, we have seen major corporations moving much of their manufacturing from China over to India. There's regulatory concerns, government concerns over in China, the slowing economy, cost concerns, and they're just, quite frankly, looking to diversify their manufacturing operations. The biggest beneficiary of all of that has been India. From a performance standpoint, Flynn has been neck and neck with the S&P 500 for the past 5 years, actually slightly outperforming, which is quite impressive. So right there, Flynn gives us the performance. Flynn also gives you diversification from a geographical situation. How about expense ratio? Well, there are a number of other India-focused ETFs, but many of them come with pretty high expense ratios. Not so much for Flynn, as they have an annual expense ratio of 0.19%, which is pretty decent, especially when you compare it to those other ETFs. Looking here, you can see the fund is diversified, but heavier in the financial sector, which accounts for 22% of the ETF. That is then followed by consumer discretionary, technology, energy, and industrials, rounding out the top 5 sectors. The top 10 positions include, which are shown on the screen, with a few names I recognize, but not many more, which is why I prefer the ETF route. In total, the fund has 234 positions. So if you're in the market looking to diversify your portfolio from a geographical location, look no further than Flynn, because the India economy and that country as a whole is firing on all cylinders. So there we just talked about 2 ETFs, lesser known ETFs that you may not already own and definitely should have on your radar. We looked at a small cap ETF, which has outperformed IWM, and we looked at an India focused ETF, which the growth that I just mentioned has been phenomenal. So down in the comments section, let me know what are your thoughts of these 2 ETFs. And if you haven't done so yet, smash that like button down below, subscribe to the channel, and we'll see you in the next one. Take care.